Hey guys, it's Dave with From Military to Millionaire, the YouTube channel. Shout out to everyone in the community. Thanks for taking some time to be with me today. If you're not a part of the community yet, go ahead and click the little red subscribe button. Check the little bell so you get notified of all of our new episodes. It's free and you will never miss another episode. Guys, today's video is on cash flow and what cash flow has to do with real estate investing. Stay tuned. Before we get into this, guys, if you haven't done so already, click that like button and then comment below. Are you a cash flow investor, an appreciation investor, or not an investor at all yet? First, what is cash flow? Cash flow is most easily described as the difference between your income and your expenses. So for example, if I have a building that rents for $1,000 a month income, and my total expenses with principal, interest, taxes, insurance, maintenance, whatever, is $900 a month, then the building makes $100 in positive cash flow or passive income. Cash flow is not necessarily a real estate related thing. It's used in business, it's used in dividend stocks, really anything that generates income. I like it as a real estate item though, and we're going to talk about it in a real estate light today. Investing in cash flow is a much safer way to invest in real estate because it hedges against market fluctuations, because you're not buying based on the value of the property, you're buying based on the income it generates. Let's use my duplex as an example. Right now it generates $1,015 in income a month. My principal, interest, taxes, and insurance is like $589. So there's $400 and some change there in difference. Now that covers some repairs and some maintenance, but in general there's about $200 worth of cash flow after everything else is budgeted for and said and done. Now if the market crashes and my property value goes from $90,000 to $60,000 or $40,000 or $0,000, as long as the tenants are still there, I'm still making that $200 a month. And so as the market plummets, I won't have to worry about where I'm going to make my mortgage payment from. And eventually it'll come back up and it'll catch me on the way up. No harm, no foul. Now, some of you were saying, well, what if the market crashes and your tenants leave? I got that, but here's the reality. When the markets crash and people who can't make payments on their fancy house get foreclosed on, they have to live somewhere. So 9 times out of 10, they're going to rent. Well, law of supply and demand, when there's more people renting as opposed to homeowning, that means there's more renters for less rentals and they become more valuable. So they actually might increase in value. Now, obviously, there's a point where the rental value has to go down as well, but the likelihood of you not being able to find a tenant actually goes down. Your vacancy actually shrinks during a recession because more people need a place to live, and if they can't afford a home, they're probably going to turn to renting. And a lot of those people who owned a nice home are not going to want to rent in an apartment when they could rent a house or a duplex, which is a little bit closer to what they were already used to. You guys have probably heard me talk about this a lot in the real estate world, that you need to buy an investment, not a home. So if you think it's gonna be your forever home and you wanna have it in a decent neighborhood and have a nice house, I got it. But if you're not sure it's gonna be your forever home, so for like us military guys who travel all over the place and live there for like 3 years but have no intention of ever going back, or at least not retiring there, you could worry about the school district, but do not let the school district or the neighborhood or whatever dictate where you buy the house. Because if you try to buy in the nicest neighborhood in the best school district, you're going to spend an arm and a leg for it, and it's just not going to rent for what you pay in mortgage. So for example, if you buy a $1 million home in an area where most homes are $200,000, that $5,000 a month mortgage payment, you're not going to find a $5,000 or $6,000 a month tenant. It's just, the likelihood is not there. The vacancies are going to be bigger, the expenses are going to be bigger. It's just not going to work out as a cash flow investment. On the flip side, if you buy a somewhat less expensive home in a decent neighborhood, you'll be able to rent it without any problem. You'll have minimal vacancy, probably less expenses, less turnover, probably still have good neighbors, and last but not least, when the market crashes, the value of the property won't fluctuate as much because it's not such an overpriced property. So the reality is that you're less exposed, you're less likely to run into issues where you can't make the payments, and also, if the worst case scenario happens and the world ends, that $200,000 home is a lot less debt to be owed to the bank than a $1 million home. So it's, I guess either way, bankruptcy is bankruptcy, but I don't know. Take it for what it's worth. Look at buying a property based on the numbers if you ever plan on renting it out. So now if you know that that's going to be your forever home, okay, maybe go a little bit extreme. Or not extreme, but get a little bit nicer. If you're not sure, buy for the numbers, because if the market crashes before you're able to sell it for appreciation, you're going to be stuck holding it. And if your property value is down in the dumps and you're stuck holding it and it's losing you money every month, it's just not a pretty situation to be in. It's not an investment. And you shouldn't buy it if it's not going to be an investment. Don't tell yourself it's an investment unless you buy it like an investment. I get this question all the time. How much cash flow is a good investment? Well, that totally depends. So a lot of people say $100 a door, but that might be a terrible return. Let me show you an example. Let's say I buy a house for $6,000 out of pocket, whether that's 20% down, 3% down, however you choose to do it. It's $6,000 out of pocket. And that house rents for a cash flow of $100 a month. So $1,200 a year annual cash flow after all expenses. In 5 years, that house will be paid off. $1,200 a year, 5 years, $6,000. It's not actually paid off, but you got every penny back that you invested in it. We call that a cash on cash return. So you put $6,000 into it, took 5 years or 20% to get your $6,000 back. Now, every dollar after that, cha-ching, positive cash flow and effectively an infinite return because you no longer have any money that actually is ventured into the deal. I mean, you do, but you've already paid off everything you used to put in it. Now, let's say that you live in a market like Hawaii, where I'm at, and you buy a $750,000 home, and you put 20% down, which is kind of standard if you're not using an FHA or a VA loan. It's $150,000. Put $150,000 down, and it still only makes $100 a month. $1,200 a year, $6,000 in 5 years. Doesn't even make a dent on what you used to put in that. In order to find the cash on cash return, you take your annual cash flow and you divide it by the amount of cash that you have in the deal. So the amount of cash you use to purchase / rehab, whatever. So $1,200 divided by $6,000 down, 20% return. $1,200 divided by $150,000 down, 0.8% return. That's terrible. There are savings accounts like Ally Bank that give you almost 3 times as much of a return as that house would be. So how can you tell me it's an investment if I can go put my money in a savings account and earn 3 times what you're earning? Sure, if appreciation goes up, but that's an if appreciation goes up. What if appreciation actually becomes depreciation? It goes down and now you've lost hundreds of thousands of dollars and you're still only making a 0.08% return? It's not an investment, guys. Inflation is outpacing the return you're getting. It is for this reason that I recommend you invest for cash flow and not for appreciation and capital gains. Just works out better in the long run and it builds passive income for you. Now I'd like to take a minute to just talk briefly on a fun way I've found to learn about cash flow. I genuinely enjoy this. There is a plug. I'm throwing a link down below, so if you want to buy it, go click on the link. It's awesome. The Cash Flow board game. Yes, this is by Robert Kiyosaki, the same Robert Kiyosaki who wrote the infamous book Rich Dad Poor Dad. This is basically a board game that teaches you about cash flow and investing for cash flow and how to get out of the rat race and all that other great stuff and building different streams of income. But it's a hell of a lot of fun to play. This game is actually so educational and so much fun to play, and it's such a good mindset game that there are clubs all across the nation that play cash flow game. And so, like, for example, like 3 different times here in Hawaii, I've gone to different coffee shops or bars and played the cash flow game with other investors or future investors. It's a lot of fun. It's somewhat competitive, great educational piece, and honestly, like I said, it's fun. So I highly recommend you check it out. I actually am going to buy the board game myself so that I can host my own events because it's just a blast. But definitely check the game out. Links down below. I love it. Yes. All right, in conclusion, cash flow is the best way to invest. All right, so obviously that's a subjective statement, but that's how I feel. Because if you don't invest for cash flow, there's a chance that while you're waiting on capital gains and appreciation, you're going to be losing money every month, which means that your asset is actually a liability until the moment you sell it and get your money back. Then it's an asset. Except what if the market tanks? Or what if you can't sell it? Now you're stuck with this thing that's a liability. It's a risk I'm not willing to take. A lot of us buy and hold real estate investors refer to the capital gains, appreciation, real estate game as the speculation or gambling game. Really not a whole lot of difference because you don't know what the market's going to do. I don't know what the market's going to do. And a lot of stock investors have lost money trying to outpace the market. Why would you try to do it with real estate? It's such a big asset to try to guess the market. I would not play that game. Cash flow investing is a great way. Now there's 3 other awesome pillars to wealth that we'll talk about in other videos. But for now, cash flow is where it's at. Love it. All right, I'm going to wrap you up with just this. Don't worry about market appreciation. Invest for cash flow, and then appreciation is a welcome bonus in the long run. That'll set you up for success. Guys, once again, if you liked the video, click subscribe, check the bell so you get notified for more videos, and please Comment down below. What are you working on? I want to hear what you're working on. Tell me.